Hi everyone, today let's talk about where the pain might end. Obviously the market has had a pretty rough week. This is the heat map for the 1 week view, and you can see almost everything is red. Just a few bright spots here in the oil and gas industry, a little bit of telecommunications, doesn't seem to move very much, but generally everything is red. A little bit here in Las Vegas Sands Corp, but most of this other industry is down. So if you had a bad week in the markets this week, don't feel bad. Everybody did. Otherwise, this is going to be a very technical heavy video where I'm going to give some of my predictions and I'll think about where the stock market is going to go from the perspective of the Russell 2000, the NASDAQ, SPY, and then of course we'll look at oil because that is one of the few bright spots in the market currently. And then I want to talk about the market breadth and then the S&P 500 divided by the M2 money supply, just to give us a perspective of where we are currently. And then I'll finish up with gold. If you're looking for a safe haven, this may be the asset for you. If you like trading stocks and options and making money, definitely like and subscribe. I make videos like this as well as portfolio overviews every single week, so make sure you hit the bell so you don't miss out on any future content. Welcome to the Portfolio Bulletin. Let's get started. Starting off here with IWM, or the Russell 2000 ETF. You can see we've been trading in this range for quite a while, from December 20 all the way to January of 22, basically trading sideways with slight ups and downs. Had a nice little pop, fake breakout here. Once that failed, we definitely saw huge moves down, where we started testing this trend line, retested again, finally broke through here. And then we have some levels of support going back to February of 20 before the crash, and the lows here in August of 19, which seem to come together somewhere here around 188 to 192, which is where I'm looking to see some kind of a bounce. And we also have a very similar trend line to the one up here, indicating a potential area for a bottoming formation and maybe a bear market rally here up to around 8%, somewhere around 205 would be my guess. And then the expectation here would be somewhere at the end of February, you get a continuation, another 10% down to maybe 183 or 184. Moving over here to the Russell Index itself, I find these pretty important to use when you want to do the longer term candles. So this is the 1 month view, going all the way back to 1988. You can see some of those bigger crashes and where they ended up landing in terms of support levels. So we have these levels here in August of 2010, October of 2011, came all the way through that here in the COVID dip. And then we have the highs here right before the COVID dip. So we have this nice little channel here. And then we have that upper channel where we created the highs in May of 2007 before the 2008 crash. And then we almost retested this. I thought we would get a retest, but we didn't quite get there. Came up a couple 100 points short before coming back and retesting this level. So if you do zoom in here a little bit, you can see there's at least 1.5% to 2% lower before we hit this level of support. And you could certainly make an argument that this is going to hold. I think that's probably a little optimistic. My guess is that we'll see at least a move down to the 50 EMA here, which is probably another 10% down overall where we are now, which is actually in line with that second move down that I was talking about on IWM. The bottom line here is the Russell does look pretty bearish here in the short term. Moving over here to the QQQs, as you can see, this trend has broken down. We've been in this trend for a very long time, going all the way back here to June of 20, rallied all the way up here to November of 21. And since then, we chopped sideways a little bit, and then we had a very clear breakdown. So broke well through that bottom trend line. Thought we might find a little bit of support similar to what we had here, slightly below previous lows. Had a little interaction with that support level that was generated there, and then a clear move down. So this is really impulsive, similar to what we had on IWM. The difference here with the NASDAQ is not a lot of decent support levels here. This could certainly fall for quite a while. You could argue maybe somewhere here around these tops, we could find a little bit of support. But my guess is that these will just be small bear market rallies and that we need a true correction before we can get any kind of continuation. Again, to see just how wild this is, I'm going over to the index itself. This is the 1 month view, and you can see the dot-com bubble here. We had that massive rally, extremely aggressive, huge move down, and then sideways price action, generally within these lower channels. Touched this lower line, which you could argue was generated back here in 1990 and 1987. Once we touch there, it's been smooth sailing all the way up. Huge rally over the past several years. But if you compare these EMAs right here to what we had during the dot-com bubble, you can see there is quite a bit of overextension similar to what we had. So if we compare the market right now to what it looked like before, we had a nice push down through that yellow line, which is the 9 EMA here. Then it pushed right through the 21 all the way down here to the 55, which is currently sitting pretty dramatically lower than where we are right now. So even if we assume that this goes up slightly, that's somewhere around 28% down from where we are right now, which is certainly not impossible. This move that we had here with the dot-com bubble was absolutely massive, around 82%. And for us to reach those highs again, it took all the way until 2015 to reach those highs and then push through them, creating this market that we've seen here recently. So that's my case for why the NASDAQ does not look as strong as the Russell, at least in the short term. Moving over to SPY, very similar to what we saw on the NASDAQ. We had this kind of narrowing wedge formation that was slightly lower than what we had been seeing in the previous trend. And since then, we've broken well through that, and this has no signs of slowing down. This is definitely a falling knife, and I don't know exactly where it's going to end. And similar to the NASDAQ, not a lot of support levels here in the recent past. Moving over again to the index here on the monthly chart, you can see this is the dot-com bubble all the way up to that high. And since then, we hadn't been above this mid-level until recently, and then we rallied well above it. And you could certainly argue that that is going to be the next level of support, somewhere closer to 4,000 points, which would be in line with that 21 EMA, which is the black line here. Expect this to kind of roll over somewhere in that same area. But if you wanted to make the argument that this is going to go even deeper to the 55, similar to what we saw actually with the 55 generating that support here during the COVID dip, dipped right down to that level and corrected from there. I think the economy is fairly strong, so I don't think we're going to see a huge correction the way that we saw in 2008. And I don't think we're currently as overbought as we were during the dot-com bubble. So I think you can make a pretty solid argument that potentially around 3,300 points would be a nice level of support. But that is still a very strong correction, closer to 25% even from current prices, which from the high would be even greater, closer to 31% from current prices from the highs, which certainly would shake out the market and could potentially generate the buying pressure needed to find a level of support and continue this trend upwards. Again, demonstrating that the Russell is currently a better buying opportunity, in my opinion, than either the NASDAQ or the S&P 500. Moving over here to XOP, because this is currently one of the strongest sectors. This is actually the 1 week chart, and I'll only do the 1 week chart here just to show this trend, because on the bigger trend, we have this slow moving downward channel, pretty wide from top to bottom. The most recent highs being at 177, lows dipping to around $30 and $40 per share. And since then, we've rallied up to around $112 per share, and we're currently back down to $100 per share. This really looks strong, and it seems like we could get a potential breakout and break of this longer term trend. And part of that is because companies like this with pricing power tend to do well in inflationary environments, which is currently what we're seeing. And you could certainly make the fundamental argument that that's why the Fed is starting to tighten, which is going to drop those growth stocks and the general indices. Moving over here to market breadth, this is S5TH if you're on TradingView. And what this shows is the number of stocks as a percentage that are trading above their 200-day moving average. And you can see we are getting really low here. So we do have this trend line that's acted as support here previously, here in March of 20, kind of support level here in September of 21, but really strong support here in December of 21, where we had a big rally up to that resistance level, and then we're coming into that point again. You could certainly argue that we may see a little bit of a bounce from current prices, which would potentially cause the market to at least flatten out a little bit, maybe rise slightly. But this is still a very clear bear trend. And what this shows is that stocks are generally going to head lower. Next up here is SPX divided by the M2 money supply, or SPX divided by M2 on TradingView. And this demonstrates how much money is currently in the stock market versus the rest of the economy. And you can see we have the dot-com bubble with massive amounts of money sitting in the stock market versus the rest of the economy. And then you can see the lows here in 2008, 2009, sitting around 0.08 to 0.1, really being those low levels, which we hadn't seen previously since the 1980s. If you get into recent price action and recent highs, 0.22 was the high here in February before the crash. We got all the way back up to those levels. And since then, we've been trending downwards. In terms of where this could stop, we do have a little bit more downward price action, maybe 3% lower, at least to that lowest level of support. It's a little bit harder to determine what the trend is here. It generally goes sideways, but because money is inflationary, generally the SPX goes up, as does the M2 money supply. If we get into these lower ranges without seeing any kind of economic downturns, that would be a pretty good indicator to start buying the market. It's definitely something to pay attention to help determine when you might want to start buying the market. And lastly, if you don't know where to put any of your money, but you don't want to be in stocks, GLD might be the spot for you. This is the weekly chart. You can see it's basically bounced between 158 all the way up to maybe 178, 79 or so for the past several months. And it's generally trending up slightly here. Don't expect a lot of returns, but it's not going down the rest of the way the rest of the market is. So it might be something to take a look at. Let me know down in the comments section what you think of these trends breaking down. Is this a long-term top? Are we going to see a bear market, or is this just a short-term correction? Definitely like and subscribe if you got any value out of this video. And make sure you hit the bell so you don't miss out on any future content. Of course, none of this is financial advice, and have a great day.